Decoding auto insurance trends, the real factors behind surging claim costs, and how top insurers respond. Lately, drivers all over Wisconsin have been opening their auto policy renewal notices only to find their premiums climbing steadily. It's easy to assume these price hikes are just arbitrary corporate greed, but deep inside official SEC financial filings, the industry reveals exactly what is driving these surging costs. We looked at these documents and we know exactly what's going on. Today, we are going to decode the twin pillars of insurance math: claim frequency versus claim severity, and expose how insurance giants categorize you into internal consumer personas to dictate what you pay. Part 1. Severity versus frequency and the coverage trends. Key point number 1, the twin pillars of insurance math. Insurance companies evaluate their performance on two main variables: claim frequency, or how often people crash, and claim severity, the average cost per claim. Here's the kicker. Even if drivers become safer and accident frequency drops, a sharp spike in claim severity means individual accidents have become dramatically more expensive to settle. When severity climbs, your premium rates inevitably go up also. Key point number 2, the raw incurred severity numbers corporate loss statements from recent years reveal exactly where the financial pressure is concentrated across major metrics. Bodily injury. Incurred severity rose by a staggering 10% in 2025, matching the high of a few years ago back in 2023. This remains the single largest financial pressure point for auto insurers. Collision repair rebounded to a 3% increase in 2025. Modern vehicles with advanced driver assistance systems are safer, but their specialized sensors, all those electronics in there, the cameras make them incredibly expensive to repair after a crash. Commercial auto. Core commercial fleets faced an incurred severity increase of 4% in 2025, following massive spikes of 9% in 2024 and 6% in 2023. Part 2. Macroeconomic drivers and consumer personas. Key point number 3, what is driving the cost explosion? According to internal financial reviews, the ones we looked at recently, total severity is predominantly driven by 3 specific structural pressures. The surge in large losses, catastrophic high-speed collisions, are yielding higher individual payouts, rapidly increasing the average severity. Escalating medical costs. Healthcare inflation regularly outpaces general inflation. Specialized care, surgery, long-term rehabilitation for serious auto injuries means bodily injury claims compound year over year. The rise of represented claims. This is the really important part. Insurers explicitly note that when an injured claimant hires legal counsel, litigation costs climb and final settlement figures increase significantly. To account for these protracted legal battles, insurance companies are forced to aggressively beef up their financial coverage reserves. Key point number 4, the customer archetypes, Wrights versus Robinsons. To control these metrics, major insurers utilize highly sophisticated consumer personas to segment risk and assign preferred rates. The Robinsons, for example, the gold standard. These are established homeowners who bundle their property in multiple auto policies. They practice safer habits, present lower risks, and stay with carriers for over a decade. Now that's compared to the Wrights, demographically stable homeowners who own their vehicles but do not bundle. Because they are unbundled, they show a higher tendency to shop around, making them less loyal and highly vulnerable to policy churn. The Dianes and the Sams, for example, lower value, auto-only segments who are highly price sensitive and immediately jump to competitors over minor rate adjustments. So what do we take from all this? The closing key points. The key takeaways. The data makes it clear. The modern auto insurance crisis isn't driven by cars colliding more frequently. It's driven by the reality that when accidents do happen, they cost far more to resolve. Insurers are actively shifting their business mix to incentivize the bundle Robinsons and price out transient auto-only policies to stabilize their books. If you're an everyday consumer, just like me, looking to insulate yourself from premium spikes, remember to embrace asset bundling. Bundle your policies. Check out other programs and protect your clean claims history. If you're an accident survivor facing a severe bodily injury claim, remember that the insurance company has already built an aggressive risk containment file against you to protect its corporate bottom line. Don't let their automated software, their computers devalue your care. Call Groth Law Firm today, 414-999-0000, or visit us online at grothlawfirm.com for a completely free, confidential case roadmap review. Let our trial team fight for your recovery while you focus on healing. Because when the stakes are highest, Groth gets it. Groth gets you.